This is a video on the price earnings multiple and as it relates to the Polaris Investing valuation formula. First off, some general comments about the price earnings multiple is that the calculation of it is fairly straightforward. You just take the current price, and we'll be using Walgreens as an example, so you're looking at that on the screen. So let's say we take the price of Walgreens of $73.47 and we just divide it by either trailing 12 months earnings or maybe a forecast of the next 12 months of earnings. We'll see later on that it's preferred that the forward-looking next 12 months earnings be used in the price earnings calculation. But a price earnings multiple is much more than that. It's really kind of a common size approach, similar to a common size balance sheet or a common size income statement, where by dividing by current earnings, you're able to compare between two stocks the relative PE multiple. So PE of 20 versus a PE of 12 can be compared and get some idea of what the market's sentiment is around the stock. That's why the PE multiple is also referred to as a popularity index. It's how much demand is there for the future earnings of this company. The more demand there is, the more price is being willing to pay for the same future earnings stream. Some other people refer to it as the hope index because it is talking about a future stream of earnings. It really measures kind of the hope or the hope that investors in consensus have for the company going forward. So just kind of jump ahead a little bit. We're going to be showing how a PE can be interpreted using this algebraic formula. But the formula represents a geometric progression of future earning streams, and we'll be getting to that during this video. Well, let's go back and review the Polaris Investing Valuation formula, which is I'm going to highlight here. There's other videos that go into this in more detail. I've seen you've seen those videos and are familiar with the page that we're currently looking at. But what I did here is I highlighted two main factors that go into the calculation, namely growth of sales and the future PE. And those are the two most dominant factors that go into the Polaris valuation formula. Now, to quickly go through the second factor in the formula, you take current sales and you grow it for 5 years, which is what Polaris uses for Y. And then you multiply that by the future profit margin, PM. And you get future earnings divided by future shares, and you get earnings per share. And now you take earnings per share times a future PE, and you get a price. And then you discount back that price at the cost of capital, and you add it to your dividend stream, and you get a present value of an intrinsic value of the company. Well, it comes down to how do you arrive at the future PE? Well, if that PE was easy to drive, you wouldn't need to go into the future. You would just simply use whatever method that allows you to determine PE and multiply it by the current earnings per share, and then you can figure out what the current price should be, or at least the intrinsic price. Well, that's not really possible. We're going to be going through that in a little more detail here, and that's why you go out to the future, and you center around the idea of mean reversion. Is why we go out 5 years. Studies have shown that cost of capital, or the return on projects, typically mean reverts to cost of capital in about 5 years. So if you move out to where that mean reversion occurs, the PE is a fairly straightforward calculation, which we'll be going through in this video. Well, let's go back and look at the use of the PE on the Polaris website. And if we look at down here at the bottom for Walgreens, we will see that the future PE that's being defaulted to is 15.4. Well, if as a user you feel like that you have a different opinion around the future PE, you usually come to that conclusion by one of two things. You either look at the historical PE, which you can look at by just from the Polaris website by clicking on this link here. I've already done that. I'm just going to go immediately to the site, and you can see here that for Walgreens, the last 4 or 5 years history of the price earnings multiple, and you can see it's ranged quite a bit. It's gone from 15 up to about 39 or 40. Average of 22.71. It's currently sitting right around 18. A lot of values to choose from. So if you're going to base your future PE, which is in the PE you're trying to determine is 5 years from now. If you're going to base future PE on one of these values, it's going to be fairly arbitrary. And to think that PE in the future is really representing future prospects of the company. Looking at historical data is a rather naive way to approach it. So another way that you might think about doing is you can go out to a site like Dr. Demoteran's of New York University, who has lots of spreadsheets on different pieces of data regarding the market. One that he has is on the cost of capital, and if I just click on US here, I'm not going to actually go through that in the interest of time. But it would show me the average cost of capital per industry. And since I have already jumped ahead briefly, I'll just point out that cost of capital can be used in actually down here and allow you to do a quick calculation of PE. So that might be another approach that you go to in order to determine a future PE. But the problem with that as well with the or along with looking at just the history of the PE for a company, is that the industry average PE is based on historical data across all the companies in the industry. So to say that that's going to be reflective of the future opportunities for this specific company is a little bit of a stretch. So really the best approach is to go forward in time to where you feel that you can rely on mean reversion to have taken place, and then base the PE calculation on mean reversion. Mean reversion means return on projects have reverted to a future cost of capital. The default future cost of capital used by Polaris depends on the operations type of the company. If operations is stable, then the future cost of capital is half the current cost of capital plus half the industry average cost of capital. If operations is dynamic, then the future cost of capital is the industry average cost of capital. As a sanity check, it's a good idea to compare the default future PE with a future PE calculated using the current cost of capital, where the future PE equals 1 plus the current cost of capital divided by the cost of capital. Well, while I'm here on the website, I want to also point out that if you're down here, let's say, trying to do a quick valuation of Walgreens, and you agree with the sales growth slider, which is the other most dominant factor into the valuation formula, and now you're just trying to think through a little bit more about the PE, is another kind of a high-level way to think through it, is that cost of capital across the for an average company in the S&P 500 averages historically around 6.66%, 7%, which is works out to about a 15 PE based on this formula that I've shown you that will go into the derivation later in the video. But corresponds to about a 15 PE. So when I see a PE for Walgreens of 15.4, that's telling me that the forecasted cost of capital is somewhere in the neighborhood of 7%. So now it becomes a categorization exercise, not a computation. You got to kind of get an idea. Do you feel like Walgreens will be in that kind of average group going forward in terms of the riskiness of its future cash flows? To get a feel for that, you can go back and look at this number here, which is 7.5%, which represents the current calculated rate of return that's expected by the market, and then decide, well, if it was 7.5%, will it maybe move towards more like 7% or even like 6.66% into the future? Another way to think about that is kind of what is the typical range? The average is 15, but you can see it typically ranges as low as 10 all the way up to over 20, depending on the cost of capital. So let's say cost of capital is 5%, roughly 1 plus 5% divided by 5% is a little above 20. And then if you take the cost of capital up to something like 10%, you're looking at a PE around 10. So 10 to 20 is a typical range that you would see for a PE. Well, just to show you how you would modify the valuation formula using the website if you had a different opinion about PE. Let's say that you assume that PE could be a little higher than 15. You feel like that in the future there's going to be more demand by the investors and it'll drive the PE up to, let's say, 17. And we're going to go more into the video how you give more thought to or a framework for determining a future PE. But for now, we'll say with 17 divided by 15.4 is about a 10% increase. Well, if we go back and look at the valuation formula, if you were to just divide out the default PE and then multiply it by now your current PE, it's just the ratio of the new user PE divided by the default PE, and we've already figured out that's about 10%. So that adds 10% to the valuation. So all you have to do is just come up here and you see that the current theoretical valuation is at 96. 10% more onto that would put you up in the 104, 105 range. So I'm just going to move the sales growth slider to the right till I see a number like around 104, and that's an equivalent way of factoring in a different assessment of PE multiple. So when I do that, I get a practical investment return of 14.6% versus the default of 11%. Since this video was originally recorded, the Polaris website has been updated with 2 additional sliders beyond the sales growth slider, namely the profit margin slider, future profit margin, and the future PE slider. So we just went through a method that allows you to change what you think about the PE multiple indirectly through the sales growth slider, but now with the addition of the PE slider itself, it's much easier to go and just enter a new PE multiple through the PE multiple slider. Well, if you're only interested in watching this video was to just know how you would indirectly enter the a change or your own opinion about future price earnings multiple through the Polaris Investing website through the sales growth slider. If that's the only interest in watching this video, then I suggest you stop watching now. But if you have an interest in deeper understanding of price earnings multiple and particularly a framework to think about how to possibly change the PE default value, then I suggest you continue listening to the video. All right, so what I want to talk about next is go into more lead-in into this formula that is related to the PE multiple. Well, most people have heard about the Gordon dividend growth model. Find that on many introductory textbooks, and lots of it out there is available on the internet. It talks about this. This has been around since the 1930s, 1940s, so it's not new. And what it simply does is it just assumes that the price or value of a company is nothing more than the present value of its dividends. And if you assume some kind of growth around dividends, you end up with a formula like this where you take the earnings, future earnings, next 12 months, take it times a retention number, and then what's left over is the payout, dividend payout, and then you assume some growth of dividends over time, and then the geometric progression for that works out to this formula, and then you get a price. Well, that's one way to do it, but the problem is that dividend policy is arbitrary or kind of discretionary by management. So it's kind of odd to use a formula that is based on a value that's not really, it's just discretionary by management. The other thing is 60% of companies out there don't pay dividends, so the formula would be could not be used on those kind of companies. So really you want a better approach than that gets more to the real drivers of value and can be used on all companies. So that leads us to this more of an earnings base where you same thing, you take the next 12 months earnings, but now you take it times 1 minus a reinvestment rate as opposed to a retention, and then you divide it by the cost of capital times the growth of earnings, not the growth of dividends. So we're going to be talking about the derivation of this formula because it's very important to have a good understanding of where it came from in order to allow you to think through what might be or form your own opinion about what a future PE might be appropriate for a specific company. Now, before I get into that more detailed derivation of this formula here, I do want to point out that, again, retention versus reinvestment, and then we've also, on the opposite side of retention, is payout. You can see here the retention is 1 minus the payout, and payout is the dividend payout. Well, reinvestment, the opposite side of that, is distribution. So when you hear the terms retention and payout, you're talking about dividends. When you hear the terms reinvestment and distribution, you're talking about cash flow. And in fact, some people listening may be familiar with the concept of free cash flow to the equity holders, which has a very specific definition, but in general it can be thought of, or more in a formula, you can think of it as just the earnings times 1 minus the reinvestment rate. And the reinvestment rate is 1 minus the distribution rate, and a distribution on average across S&P 500s is actually working out to about 2 times the dividend payout. So what we're talking about there is it relates back to the dividend discount model, or the Gordon growth dividend discount model. Instead of just receiving a dividend, when you're talking about free cash flow, yes, dividend is one way that the stockholder is compensated for investing in the company, but also there can be stock repurchases, or management can choose to just hold back a certain amount of earnings in a given year as cash or some kind of short-term investment on behalf of the equity holder, and then with the idea of maybe using that for projects that have yet been identified. But until it gets reinvested in the operations of the company, it's essentially owned by the stockholder, particularly if it goes into cash, and if the company was ever liquidated, in theory, the cash would belong to the stockholder. So there's 3 forms of distribution: dividend payout, stock repurchase, and parking of short-term parking of funds. And then on average, it's 2 times the payout. So if the dividend payout is $2, then it's assumed that the free cash flow on average would be about $4. All right, well, let's get into the derivation of this formula. And I know this diagram looks a little daunting, but we're going to quickly go through it. And I think once we go through it, you'll be easily understood. We're going to assume that here in the first year, at the beginning of the year, that equity holders, maybe through like an IPO, make an initial investment. So this is not the number 10. This is investment I at time 0, and I'll refer to that as I naught. So some initial investment is made at the beginning of year 1. And then at the end of the year, there has been a return earned on that initial investment. Management makes a decision to reinvest into the company a percent, and that we'll just use that the number, the symbol percent to reflect what percent they choose. But the percent of the return on that investment is reinvested back to the company. Well, that means 1 minus that percent of the return that was earned is distributed to the stockholders. Again, it can be more than just a dividend. It could be a dividend, stock repurchase, or some kind of short-term parking of funds is all a form of distribution to the stockholder. Now, when we go into the second year, you still have the original I naught that's been invested by the when you did the IPO, but now you've had a reinvestment of RI naught %. So now we add the total investment at the beginning of the year is the original I naught plus this RI naught, and so now you get and when you do the algebra, you get I naught times 1 plus R %. Well, if we think of R % we'll call that growth, because that's really what the difference between the previous year and this year is instead of it just being I naught, it's now I naught times 1 plus something, which is the growth. Now, I want to point out that this growth factor is based on a static R, meaning the R will stay the same during the in years that we're looking at, and also the % will stay the same. So the growth is fixed during this end period. If you were to want to think about a company where the return changes or the % that's reinvested changes, then you have a new period that you need to factor in, and now you end up with a multi-period model. But in this more simplified view, we're just looking into a single period model where R and the % stay constant through the whole period. All right, so now to continue on, here we are in the second year, so now you get a return. You get a % of that return is reinvested, and then you get 1 minus that is distributed out to the stockholders. And then from then on, you can see that the pattern is now developing that from year 2 to end, it's just each year you're factoring an additional component of growth, an exponent of growth. So it starts off to the 0th, to the 1st, to the 2nd, and all these columns, either if you're talking about the total investment at the beginning of the year, the return that you earn that year, the reinvestment, or the distribution, they're all increasing year over year by a common growth term of 1 plus R %. Well, before I move on, I do want to point out that free cash flow, which we introduced earlier, in this diagram is equal to the RI naught times 1 minus %. Is the free cash flow in the first year, free cash flow in the second year is that same factor, but now times the growth factor, and you get the idea. The other thing I want to point out is that RI naught is the same thing as your initial earnings, move for possibly looking backwards, but then growing forward for 1 year. So RI naught is equivalent to that expression. Well, let's focus on this leftmost column now. Since that is the distribution to the equity holders, if we do a present value across those in years, that will give us some of the, well, if we let n go to infinity, you would get the value for the company, because at the end of the day, the value of a company is its future flows back to the stockholder. And that present value of that, since this is a geometric progression, can be proved to be just RI naught times 1 minus the reinvestment rate times this factor, if you can cut it off after 10 years, and then divided by the cost of capital minus growth. Now, I want to point out that since it is a geometric progression, it only works if cost of capital is greater than the growth. So assuming that that is true, you then see here in this middle factor that if you go out for an infinity years in terms of n, and the cost of capital is larger than R, this term here will go to 0, and so the middle term becomes just 1, and so you end up with the formula that we've seen already, namely 1 minus the reinvestment rate divided by cost of capital minus the return times reinvestment, which is the same thing as growth of earnings. And then when you divide both sides by earnings, and get the price earnings multiple, you're also left with the 1 plus factor, which is what I showed here, and what IR naught is equal to. So we divide both sides of the price to get the price earnings multiple by earnings per share, you're left with a 1 plus G on that side of the equation. So that's where the 1 plus G comes from. So hopefully this gives you a good foundation that we can work from now to talk about three specific scenarios dealing with this formula. One is mean reversion, which is what happens the majority of the time, and really is what the Polaris website defaults to in terms of its numbers and all that kind of thing. That it does assume mean reversion does occur. Now, a few exceptions could be where you don't have total or you have mean reversion, but the companies continue to be able to grow at least at the rate of the economy. And then the very rare exception is where you have uncapped growth. So we will be going through each one of those separately now. All right, next we're going to be talking about mean reversion. And since now we have an idea of where the formula comes from, mean reversion simply just means we're letting the return equal the cost of capital. That at some point a company will no longer be able to, through competitive pressures, be able to continue to earn a rate of return on its projects greater than what the market expects in terms of cost of capital. If they are, then in theory the competitors would step in and drive that return down to the cost of capital. Well, if we assume the return is cost of capital, and that goes in here, you can plug in cost of capital. Now you get a common term of cost of capital, and it factors out, and you end up with this formula here. And then when you factor it out, you get 1 minus reinvestment in the denominator and 1 minus reinvestment in the numerator. Those cancel out, and you get a very straightforward formula for the price earnings multiple. And that's why you go forward until this mean reversion occurs, and so you do end up with a very straightforward calculation for the default value that Polaris uses. Now, this doesn't always apply, but it applies often enough, and the majority of the times, that it's what the Polaris website defaults to. Now, to give an example of when it doesn't always apply, there was a very famous case back in the 90s involving long-term capital management, a company that went out, hired a bunch of finance PhD types, and they pushed this mean reversion concept to an extreme, and it didn't work out well. And it kind of reflective of a comment that was made by John Maynard Keynes way back in the 1950s. He said that, the market can stay irrational longer than you can stay solvent. And here, these PhDs were applying a very sound theory based on eventual mean reversion, and they made enormous bets on that, but they just didn't have the means, financial means, to stay the course, because mean reversion can take up to 20 years for some situations to play out. Now, studies have shown that mean reversion usually occurs in about 5 years, and in fact, competitive pressures start to cause mean reversion to occur very quickly. Some studies have shown that as much as 40% of a competitive advantage disappears year over year, and then is totally gone within about 5 years. But it's not always the case. It's mostly the case. So let's go back to the Polaris website and look at the default value for the PE for Walgreens. This is based on mean reversion, and it applies to most companies, and Walgreens is likely one of those companies. We'd have to do more inspection into Walgreens to feel comfortable with that default value, but the default value on the Polaris website is always based on. Well, Dr. Demoterin, who I referred to earlier, has looked into this extensively and has concluded that at best 20% of companies will be able to grow some after a 5 or 6 year period, even with competitive pressures, but not much. He's saying that if a company cost of capital maybe is 7%, they might be able to grow at 8, 9, maybe 10%, which is about up to 3% greater than their cost of capital. But that's about it, and that just shows you how strong competitive pressures are. Well, what kind of competitive advantage would a company have that would allow it to continue to grow at above cost of capital, rates of cost of capital? Well, these are companies that typically have a very strong brand or reputation. They may have some kind of intellectual property that's, that they have trademarks or copyrights to. which amounts to kind of government protection. They may have access to limited natural resources. They may have developed very skilled employees that's hard for competitors to replicate. There could be the first mover phenomenon, particularly with high-tech companies. You see this where they have key customers and supplier relationships that now as newcomers come in and try to compete with them, they just can't break into that kind of supply network or key customers. There can be unique processes that are developed that just competitors find hard to replicate. So this would allow them to continue to grow, but not unbounded. And most companies in this situation will be capped. Their growth will still be capped by the growth of the overall economy. And a good proxy for the growth of the economy is just the risk-free rate of return, which is the 10-year Treasury note typically. And that currently is running around about 2.5% to 3%. So if the growth of earnings is now capped by RF, we can calculate a growth of our earnings, but we have to keep in mind that it's capped by this RF. So if you divide both sides, the expression for growth of earnings by a retention value, and make it equal to RF, you get RF divided by retention is equal to what I refer to as the second phase return factor. So if we feel like that they can earn maybe 3% more than their cost of capital or 2% more, that would be reflected in this number here. And then you would add 1 to it, multiply it by the retention. And I actually went the wrong way earlier. If you take the GE and divide it by this factor, it'll tell you what the retention the company, the maximum retention, reinvestment that the company will be able to make when they're capped by a market or overall growth of the economy, which is reflected by RF. Well, another way to look at this is through this spreadsheet that I've created, that if we look at different cost of capitals and then what the typical multiplier is, if you were to have, in this case, just one of 10% additional return on capital over the cost of capital, what kind of multiplier would it have on the PE? And you can see here that it tends to be around about 5% regardless of the cost of capital. So one way to think through this is if you're going to give a company the benefit of continuing to grow some even when they fully have saturated the current market, is that number typically is only about 5, maybe 10% of the current PE. So that's not a huge bump, but it is a way to rationalize a little bit bigger PE over the default PE. But again, like Dr. DeMondron, I mentioned about what he said, is that at most maybe 20% of companies would be in this type of situation. All right, the last thing I want to talk about relative to the PE is a third situation dealing with uncapped growth. All right, we're dealing with a third situation regarding price earnings multiple. I want to point out that we're dealing with a very unusual situation that probably impacts maybe just a handful of companies, and that is where they continue to grow uncapped by the growth in the overall economy. And these companies could be thought of as kind of serial reinventors of themselves. And a recent example of that is Microsoft, that it was originally viewed as a desktop operating system kind of company, and then they hit a kind of a wall right at the beginning of 2001, 2002, and in fact we can see this clearly in the price earnings multiple that the market was paying for Microsoft during this time. I'll go back just a couple of years, but even if we go back to 2014 all the way, let alone all the way back to 2001 or 2, you can see that we had for a long time a very low PE. And then all of a sudden, Microsoft started making moves into a new market area dealing with the cloud. And then here recently, the PE spiked up enormously as the market came around to the idea that Microsoft was successfully moving to or pivoting to a much higher growth area than where they've been in the past. So companies like Microsoft that can successfully pivot to new opportunities, they can continue to make healthy revenue from their previous lines of businesses, but then they can go off and grow even more into new areas. Again, it's a very rare and somewhat of a speculative almost story that gets associated with the company. And that's why if you're, look at companies like Microsoft that have, by the way, current PE of 78 when they were having a PEs down around 13 or 14 just 5 or 6 years earlier, it becomes a very speculative kind of buy because there is a lot of hopes and dreams that are put into that kind of a PE that Microsoft will continue to be able to do this kind of reinventing of itself, and that's why I say it's just a very few number of companies. Most companies, particularly companies that are in distressed situations that are being forced to pivot, typically make bad choices about where they choose to reinvest and actually end up destroying value instead of increasing value. But for the few that have demonstrated that they can do it, that there's typically a very high PE multiple that's built into their price. So let's talk about how you would come up with a defensible PE for a few companies that are in this situation. Well, what you do is you go back to the original formula for PE, and you take 1 plus the growth rate of earnings. But now with these kind of companies, the mature companies like this, the typical reinvestment rate that they gravitate to is around 33%. So then in the denominator, you're just thinking through what the cost of capital might be relative to growth of earnings. So let's take Microsoft. Well, you assume that 7.5%, 8% cost of capital. Now this boils down to what rate of earnings do you think the company can continue to make? Because you've already assumed that you know the reinvestment rate. Well, as you're thinking through earnings, remember that earnings is equal to return times reinvestment. Since we're assuming the reinvestment is 33%, you can determine either a return that you think Microsoft will be able to continue to make, and this multiplied by 0.333, or you can come up with a growth in earnings divided by 0.33 and see if you're dealing with a realistic return. Well, if you're going to start off with the return, it's important to understand what the return is in the current, what it is currently for Microsoft. Well, the way you would calculate that from the Polaris side is you would have to know that the relationship between growth of earnings and growth of sales, because again, on the website, the only thing you're seeing is growth of sales, which you can modify up here or take the default value. Because you'd have to convert the growth of sales and the growth of earnings. I'm not going to go through what it is, but you can come back to this video and pause it here. You can see what the formula is. And then once you know the growth of earnings, because you are assuming a 0.33 reinvestment rate, you can now calculate what the current return is. And then if you're going to go forward with a cost of capital, let's say of 8%, and let's say you go through that calculation like for Microsoft, and you figure out the current returns maybe something around 16 or 17%, you've got to decide between a cost of capital of 7.5%, and a current return of projects of this, I forgot what I said, 16 or 17%. Where are you going to land in terms of what you think the company can sustain going forward? Typically, you look at something in between that, and then calculate what that means in terms of growth, plug it into your formula, and then you get a PE, even for companies like Microsoft. Well, I'm going to take you back to the spreadsheet for a second and talk about this concept of continually pivoting. The few companies that can do it. If you assume a reinvestment rate of 33%, then I'm going to go up here and assume that the additional growth that you think the company can maintain is 0.8 greater than their cost of capital. Well, by doing that, you see here that the multiplier you end up with to the current PE is 0.65. Well, you can play around with how much you think they will actually be able to do in terms of on top of their cost of capital, but you typically will end up with around a 33% up to about a 75% additional bump to the PE.
This video was originally recorded. The Polaris website has been updated to include some additional sliders and also capturing some additional information when a plan is added. And one of the new sliders is the future price earnings ratio. So here's Microsoft, and let's say that we want to, instead of using the default PE of 14.8, we want to change it to what the company has been doing recently in terms of PE, namely 25.2. So I'm going to add that to plans. Now let's go look at the plan. Scroll all the way to the right, and there's been some additional data added to when a plan gets recorded. It helps you think through this, what's really implied by this increased PE ratio. So we upped it up quite a bit over its default, and you can see here that the implied future return built into that kind of a increase in PEs, we're assuming 13.2% annual return on projects by forecasting that big of a future PE. And that compares to the future cost of equity of 7.2. Well, the future state that's normally assumed beyond the 5 years is that a company returns the future cost of equity, namely 7.2%. So by moving that PE multiple up to 25.2, where we can see here that that implies a 13.2% annual return on project, which is almost double what the expected cost of equity is. So that would have to be given some serious thought as do you really think a company, Microsoft in this case, can really forever return this high of a return compared to what the market would expect it to return. And this is based on assuming that Microsoft as a mature company is reinvesting 33% of its earnings. Also, this implies a future annual earnings growth of 4.4%. And when you consider that in this high growth period during the first 5 years, we assume 12% earnings growth, we've got to think, well, can we really assume that they will continue to be able to grow earnings forever at 4.4% when the future risk-free rate of return is expected to be 2.5%, which is also a proxy for the growth of the economy. Can Microsoft grow its earnings 4.4% when the economy is only growing at 2.5%? So that's almost double the growth of the overall economy. It's almost double the rate of return of what Microsoft would expect it to be earned on its projects. So hopefully this allows you to think, or a user to think through a little bit more really the true significance of this PE ratio, although this number here, 25.2, is just the historical average PE. The future PE is over here at 25.2. For more information on checking the PE multiple, see the infrequent sustained abnormality video blog around the 50-minute mark. Okay, so let's quickly go through what's been discussed in this video.
It boils down to, which of three scenarios are you going to be talking about? So I'm talking about the text down here. Is you're either talking about the majority of the time and what the default value is when you're looking at a stock on the website is the mean reversion, and the PE is simply what your future cost of capital that you're estimating is, and then that's a straightforward formula. So majority of the time, maybe 90 plus of the companies you look at, you just use the default and assume that they mean revert in 5 years. Occasionally, Dr. DeMondren's statement is maybe 20% of the companies you just go with a multiplier of anywhere from 5 to 10%. And then rarely, a handful of companies, you go with uncapped growth. The bump in PE could be anywhere from 33 to 75%. And best to go back and use the formula itself to figure out exactly how much of a bump you're looking at for those kind of companies. So I know this is a long video, but it covers a very important topic of price earnings multiple and gives you a framework of how to make the change. Thanks.